While it might be interesting to discuss Bronze Age banking or classical banking or even early modern banking, what I'd like to do in this next segment is discuss the evolution of banking in North America, in particular in the United States and in Canada. So, after the Revolutionary War in America ended, there was a very, very strong need to consolidate war debts. Unfortunately for the government at the time, they had spent so dramatically that they owed roughly 400 times annual government tax receipts. And to even further complicate the problem, many states had individual level debts as well that needed to be consolidated and rationalized in order to facilitate the flow of resources in newly independent America. So, perhaps unsurprisingly, a central bank was created, the topic of our next major lesson, back in 1791, known as the First Bank of the United States. Now, this First Bank of the United States was a commercial enterprise, but it was also the government's exclusive banker, which made it sort of play both roles in a way similar to what the Bank of England had done throughout the 1700s, both acting as a commercial entity, but also as the exclusive government banker. Now, outside of the central bank, banking as a whole across America remained deeply regionalized. Remember that the nation itself had grown from a collection of individual colonies, each of which had been founded by people who had unique visions that were intent on maintaining their independence to some extent. And as a result, they tended to be suspicious of efforts to centralize both economic and political control in ways that mirrored the English or the English system that they had, their ancestors rather, had left. So you'll notice that under the US Constitution, currency might be a federal prerogative, but banking strictly is controlled by the states. As a result, we have a number of different kinds of banking regulations in the United States that persist to this day, with every state setting their own standards. Now, this, of course, is particularly challenging for organizations that hope to grow beyond the state in which they are founded, because it requires you to comply with an entirely new set of regulations as soon as you try to expand beyond your home state. As a result, the average US bank is generally very small and relatively inefficient. Compared to the roughly 50 Schedule 1 banks we have in Canada, there are over 5,000 banks in the United States. But the assets in the banking sector are becoming increasingly concentrated in the largest national scale banks. Nonetheless, there is still a very significant presence for small community or unit banking throughout the United States because of its regulatory structure. And we see this decentralization of banking persisting not only in the commercial banking realm, but also in the design of their central bank, the Federal Reserve System. Rather than being a singular institution like the Bank of Canada or Bank of Japan or Bank of England, the Fed is actually a network of regional nodes rather than a single entity. But we'll discuss that more in our next lesson on central banking. What I'd like to do now is talk a little bit about how the American experience with banking influenced the way that we designed our banking regulations in Canada. The first thing to note is that by the end of the revolution, the Civil War in the United States, Canada found itself in a particularly challenging geopolitical environment. In 1865, the Union Army had approximately 2.2 million men armed and the ability to move them rapidly across the continent with a couple of north south train routes that were particularly important. By comparison, the sum population of the entirety of British North America was 3.4 million people, counting all of the elders and children as well. So, unsurprisingly, future Canadians, who were the inhabitants of British North America at the time, were quite concerned, given that America had now been clearly unified under a strong force. There was concern about how the various British North America colonies would be able to retain their own independence and keep themselves as not America. So the solution was fairly simple. Within 2 years, we create the country of Canada that stitched together the various BNA colonies in an attempt to try to provide some scale solutions for both defense and for developing its economy so that the various colonies wouldn't simply be absorbed into the United States itself. So, the structure of Canada's banking laws are largely built on the demographic and security realities that we faced at this particular time. The general impression of Canadian Parliament was that a national level government required national scale banking. In other words, if we were going to finance the federal government and the federal government was going to finance any sort of infrastructure development, for instance, or provide for national security, we would need to be able to draw on resources not simply from individual colonies, but to be able to draw on the strength of an entire nation in order to coordinate these sorts of large scale projects. Now, in Canada, unlike the US, banking is regulated at the federal level, but there was no central bank created in Canada until 1935. Again, we'll discuss this a little bit more in our next major lesson, but a corollary to this was that trusts and securities, which ultimately turned out to be fairly important in the 20th and 21st centuries, were at the time seen as being relatively unimportant. And even though a trust largely mimics what a bank does in terms of borrowing money and making loans with it, they were seen as being relatively small. And as a result, they were left to direct provincial regulation instead of federal level regulation. Perhaps the most important turning point in early Canadian banking, however, was the Bank Act of 1871. And the reason this was so important is because it was actually required in the Bank Act that the laws be revisited every decade. In fact, now we do this every 5 years since the late 20th century. But this is particularly important because it's allowed us to continually update and revise our banking regulations to keep up with the evolution of our regulatory frameworks and our competitive environments. And this has been one of the essential things that has allowed Canada to develop such a strong banking system over time. Comparatively, America's banking system is burdened with a number of legacy issues, some of which are well more than a century old. In Canada, we've been able to avoid that by requiring that our parliament regularly revisit banking laws on a semi-decennial basis, even if they end up changing nothing. Another interesting aspect of the 1871 Bank Act was that it imposed a double liability on bankers. Normally in a corporation, the investors are only limited in their liability up to the amount that they have actually invested themselves, i.e. shareholders can go to zero, but they can't go negative. With a double liability provision, if you invested, say, $100, you could actually find yourself in a position of being liable for a total of 200. In other words, all of your equity is wiped out and some of your personal wealth as well. And this was being done to effectively discourage risky lending practices. And we do see some use of this in the United States as well, but it was a major component of Canadian bank regulation until 1934. Now, in terms of issuing currency by our banks, the government did issue some currency directly starting in 1868, but the overwhelming majority of Canadian money was in fact issued by our banks. Now, given that the banks did not have a lender of last resort, they were, of course, had a discount applied to all of the bank money that circulated, whether these were notes or coins, depending on how risky people felt the particular issuer happened to be. But of course, this creates problems when banks fail, because currency is effectively a liability of a bank. It allows you to exchange whatever the token is for some value in the ledger. And the biggest problem we ran into was in early bank failures, it wasn't clear how high up the order of priority holders of currency were, which of course discouraged people from accepting these kinds of currency issued by banks as a form of payment. So in 1880, the laws were amended again during the next revision of the Bank Act, and it was assessed that those who were holding a bank's currency were given first lien on its assets in the event of bankruptcy, meaning that you had first priority in seizing the collateral on the bank's loans in order to make yourself whole. 10 years later, we expanded this even further and created what we would recognize as the forerunner of the Canadian Deposit Insurance Company. There was a common fund that was established between banks who would not necessarily just guarantee deposits, but would instead guarantee the currency that was being circulated. So rather than guaranteeing that your deposits would necessarily be safe, they ensured that any currency issued by any of their members could necessarily be redeemed at face value. Now, as we emerge into the 20th century, we do see an interesting bit of evolution in Canada. It's not particularly Canadian, but the intensity with which we adopted this solution does make it stand out. And this was the creation of Canada's credit union system. Generally, credit union systems begin to emerge when particular groups find themselves underbanked or not who find that they don't have access to the financial plumbing that makes an economy so successful. And we had two particular frictions that impeded the development of certain communities in Canada. The first, of course, was distance. A lot of people still living in rural areas in 1900 found that it was particularly challenging to have to travel sometimes more than a day to be able to have an appointment with their bankers. So between that and the English-French divide, which is an unfortunate issue that has persisted in Canada for hundreds of years, what we found is that there was a strong desire for more localized banking structures as opposed to money-centered banking. So looking back 120 years ago in 1900, we see the creation of an illegal credit union by 100 people in Lévis, Quebec. This particular credit union actually ended up growing substantially and became official in 1906. And this is what we recognize today as the Desjardins Group, otherwise known in Quebec and Northern Ontario as La Caisse Populaire. La Caisse technically has today over $300 billion worth of assets, and it serves approximately 7 million people and organizations across the country. In fact, Canadians' tradition with credit unions is so strong that it was Canadians, French Canadians, who set up America's first credit union, St. Mary's Credit Cooperative Association, now St. Mary's Bank, back in 1908. The idea of localized banking structures spread after having a particularly challenging time throughout the Great Depression, where Western farmers felt that Ontario and Quebec bankers in the East were happy to accept their deposits, but unhappy to provide them with loans. The locals also adopted the notion of creating their own banking structures for themselves, lending their own local surpluses to local borrowers. And so from the 1940s onward, the government of Saskatchewan was very, very fierce in encouraging the formation of more credit unions. And today, we see a substantial concentration of the use of credit unions in both Quebec and Saskatchewan, communities that had found themselves isolated or disregarded by the powerful money center banks in the East. As many as 70% of people in Quebec today use a credit union, and the number in Saskatchewan is approximately 60%. When we look across the size of credit unions in the country, though, we see that they only hold about 10% of all deposits. And that means that while it has attracted a lot of attention from households, it hasn't necessarily attracted attention from large business depositors. So one final thing to discuss when it comes to Canadian banking in particular are some of the major changes that emerged over the course of the 20th century in commercial banking. One of the big watershed events in 20th century Canadian banking was the failure of Home Bank in 1923. This is largely due to poor risk management, but also insider lending covered up by accounting fraud. At the time, this was a major problem. They estimate that as many as 60,000 depositors faced ruin and only ended up recovering maybe a quarter of their total deposits, despite there being a double liability provision in place to protect them. Now, the federal government, in order to prevent a serious break with these people, stepped in and provided additional funds to make them as much as 60% whole, but only on deposits under $500. At the end of the day, this sort of crisis really galvanized Canadians into recognizing the value of something like deposit insurance and the idea that we required better bank supervision and perhaps in certain cases, a lender of last resort. Not that a lender of last resort would have saved home banks depositors from the fraud that was committed, but having some kind of central bank in place may have helped to alleviate some of the consequences of the home bank failure. And that contributed to the political move to create the Bank of Canada in 1935. Now, it's worth noting that Canadian banking has one very strong advantage over American unit banking at the state level. And this is the idea of branching. A branch of a bank means that I can take depositor money from Nova Scotia and lend it out to a branch that needs cash in British Columbia. The ability to move wealth around on a ledger really helped Canadian banks to avoid the kinds of challenges that American banks faced during the Depression, when nearly half of American banking institutions were closed in the span of just the first 5 years. Comparatively, no Canadian banks at all failed during the Great Depression. And largely, this was due to geographic diversification. Organizations like the Bank of Montreal had branches all over the country, and this allowed them to move money to where it was most necessary, avoiding liquidity crunches in particular areas, and of course, diversifying losses associated with a particular geography across a national scale institution. It's also worth noting, though, that Canadian banks established over the 20th century a very large international presence. By 2000, our big Canadian banks tended to have international footprints of anywhere from a third of their assets to nearly half. So Canadian banks have not just stayed home, they in fact have very significant presence in some other areas. For instance, if you travel to St. Martin in the Caribbean, the largest lender on the island is Scotiabank. If you travel to Boston in the United States, you'll recognize that the arena where the Boston Bruins play is TD Arena. So you'll see these sorts of Canadian echoes in the American market, particularly in northern and eastern states. But Canadian banks have traditionally been a little bit cautious about how they move internationally. And it is tended to be a matter of moving slowly and deliberately so that they don't have to retreat. Now, during the 1980s, we saw one more significant shift in the structure of Canadian banking, and this was the dissolution of what we called the four pillars of Canadian finance. You can see it here in this comic that's sort of describing how various financial institutions supported the overall national economy. And what happened is that we removed the regulatory boundaries that prevented commercial banks from merging with trust organizations who were taking longer term deposits and making longer term loans, allowed them to merge with insurance firms and with investment banks. Within a decade, nearly every one of the large Canadian banks had merged with both a trust and an investment bank. And in the last 20 years, many of them have begun moving into offering insurance products, even if they can't necessarily be sold directly in a bank branch. Now, by diversifying not only across geography, but also across area of financial intermediation, Canadian banks have shown themselves to be remarkably resilient. Even though we pay the highest bank fees of any country in the world, these bank fees do fortify the profitability of the banks and give them a significant buffer with which they can absorb losses when times are particularly difficult. So it's worth noting that since the 2008 financial crisis, Canada has consistently ranked among the most stable banking systems in the world. In fact, our central banker at the time, Mark Carney, was elevated to Olympus, you might say, being called up to serve on the International Financial Stability Board, and later even being recruited to run the fabled Bank of England. Unfortunately, since 2018, Canada has begun to slip a little bit in terms of our rankings. And this may be entirely because of the exposure that our banks have to the kind of substantial increases in property prices that many others around the world have interpreted as a property bubble. So Canadian banks will need to be mindful of chasing down higher yields in different kinds of markets or in different kinds of products. Traditionally, their success has relied on the fact that they are well capitalized and fairly conservative lenders. Hopefully that will allow them to see through the COVID-19 crisis and emerge healthier on the other side.